It's the final trading session of January, a Friday no less, when markets usually calm down and traders start thinking about the weekend. Instead, we got absolute chaos. In a matter of hours, silver fell off a cliff, dropping from around $121 to $95. That's not a dip. That's not a pullback. That's a $26 move that normally takes months, compressed into a single trading day. Gold didn't escape either, sliding from roughly $5,600 to just under $4,950. $650 erased like it never existed. If you saw those candles print in real time, your stomach probably dropped faster than the price. Now, if you're watching this with your heart rate elevated and your portfolio tab still open in another window, pause for a second. Seriously, take a breath. Because what just happened looks dramatic on the surface, but the deeper you dig, the less sense it makes. The numbers don't align, the behavior doesn't match the narrative, and the story being told by price alone is missing some very important chapters. Silver just logged one of its worst weekly crashes in years, down more than 20%. In a normal world, that kind of move would flood the market with supply. Sellers would rush in, dealers would be overloaded with inventory. You'd expect discounts, promotions, and banners screaming, "Buy now," everywhere you look. That's how functional markets behave. But that's not what's happening, not even close. Right now, at this exact moment, you cannot reliably buy physical silver. Not easily, not in size, not without delays, rationing, or eye-watering premiums. The Perth Mint in Australia has paused sales. The US Mint has suspended products. The Royal Mint in the UK is out of stock. In India, dealers aren't just low on inventory. They're failing to deliver metal that's already been paid for. Costco, of all places, has imposed purchase limits. Let that sink in. The price is collapsing on screens, yet the metal itself has practically vanished. Think about that contradiction for a second. Price down, supply gone. Does that sound like a real market to you? Or does it sound like something is fundamentally broken? In any functioning system, falling prices bring abundance. Here, falling prices are triggering scarcity. The lower the price goes, the harder the metal is to find. That is not how commodities are supposed to work. And by the end of this video, you're going to understand why this disconnect exists and why reacting emotionally to the crash could be one of the most expensive mistakes you make this year. This channel focuses on what's happening beneath the headlines, where incentives, leverage, and structure matter more than sound bites. If that kind of analysis is useful to you, make sure you're subscribed. And if this video helps you think more clearly instead of more emotionally, goes a long way in getting it in front of others who probably need it right now. A few days ago, I talked about silver approaching a critical zone around $117. I walked through long-term historical patterns and explained why a sharp move lower was not only possible, but likely. At the time, optimism was everywhere. Sentiment was euphoric. And now we're here. The drop itself didn't surprise me. What did surprise me was what happened alongside it. While paper prices were imploding, the physical market didn't just tighten, it fractured. To understand why this matters, you have to understand how the silver market actually works, because most people don't. And that misunderstanding is expensive. There aren't one but two silver markets operating at the same time, and right now they are telling completely different stories. The first is the paper market. This is where futures, options, ETFs, swaps, and derivatives trade. It's where hedge funds, banks, and institutions move enormous volumes of silver exposure every day. But here's the part most people gloss over. They're not trading metal. They're trading contracts, promises, IOUs that say silver will be delivered at some point in the future, even though the vast majority of these contracts are never settled with physical delivery. They're rolled, netted, or closed out in cash. It's financial silver, not real silver. Think of it like a massive poker table. Chips fly back and forth, fortunes are won and lost. But at the end of the night, nobody walks out with a wheelbarrow full of metal. It's leverage stacked on leverage, and price is determined by positioning, margin calls, and forced liquidation far more than by supply and demand in the real world. The second market is the physical market. This is the one that actually involves metal you can touch. Coins, bars, industrial silver that goes into electronics, solar panels, medical equipment. This market doesn't care about leverage ratios or margin requirements. It cares about one thing: availability. Either the silver is there or it isn't. Under normal conditions, these two markets stay loosely connected. Paper prices influence physical prices, and physical shortages eventually feed back into paper pricing. But right now, that connection is broken, completely. The paper market is screaming that silver is worth $95. The physical market is quietly responding, "You can't have any." One of these signals is lying, and history suggests it's usually the one made of paper. Let's look at the evidence, starting with the Perth Mint. This isn't some fringe dealer or small private refinery. This is one of the most respected government-backed mints in the world, producing bullion for over a century. Before the crash even began, while silver was still trading near $117, they sent a notice to their wholesale distributors. The message was clear. Worldwide demand for silver bullion products has surged, creating a large backlog of orders. As a result, they are pausing new wholesale orders for their flagship 2026 Kangaroo 1-ounce silver coin until late February. Read that carefully. Increasing demand, large backlog, pause on orders, allocation management. This is the language of shortage, not surplus. And this announcement came before the price collapse, when everything supposedly looked fine. Australia is one of the world's major silver-producing nations. And its own mint can't keep up with demand. That alone should raise eyebrows. But then the price dropped another $20. Ask yourself honestly, what do you think happened next? Did demand disappear? Or did every investor who understands value just see a massive discount on an asset that was already in short supply? Exactly. Demand exploded. The crash didn't scare buyers away. It brought them in. The same pattern played out in the United States. The U.S. Mint suspended sales of multiple silver products, officially citing pricing updates. Unofficially, the issue was simple. Prices moved faster than their systems could adjust. They were selling silver at levels that no longer made economic sense, effectively locking in losses. So they stopped. When products reappeared, prices had jumped dramatically. In some cases, premiums nearly doubled overnight. The delayed release of the 2026 Silver Eagle and the fact that subscriptions are already sold out tell you everything you need to know. Then there's India, a market that doesn't speculate on silver but actually uses it. Jewelry, industry, savings. And right now, dealers are defaulting. Not delaying, defaulting. Orders paid for, metal not delivered. That's not volatility, that's stress. So step back and look at the big picture. Paper silver just experienced one of its sharpest declines in years. Physical silver, at the same time, has become harder to source globally. Mints are rationing, dealers are empty, governments are pausing sales. That divergence is not noise. It's a signal. The danger right now isn't the price action itself. It's reacting to it without understanding the structure behind it. When markets break like this, they don't fix themselves quietly. They resolve violently. And when they do, the resolution rarely favors those who panicked at the bottom while staring at a screen instead of looking at reality. This isn't about hype or fear. It's about recognizing when the story being told by price no longer matches the story being told by supply. And when that happens, it pays to stop, think, and question what you're being shown, because sometimes the loudest signal in the market isn't the crash, it's the silence where the metal used to be. If you still think this is just a temporary supply hiccup or a few unlucky retailers having a bad week, let me reset the picture for you. Because what's happening now has crossed a line. This is no longer about delays or logistics. This is about outright failure in the physical delivery system. In India, one of the largest real-world silver markets on the planet, Amazon sellers are canceling silver orders after payments have already been accepted. People are posting screenshots showing confirmed purchases, money taken, and then, days later, orders quietly voided. No shipment, no metal, just a refund and an apology. That's not a demand spike causing a backlog. That's a system saying, we don't have the silver you thought you were buying. And if this were happening at one online platform or with a few small dealers, you could shrug it off, but it isn't isolated, it's spreading. Which brings us to Britain, the Royal Mint, the official mint of the United Kingdom, one of the oldest continuously operating mints in the world, with over 1,000 years of history behind it. Empires rose and fell while this institution kept producing coinage, and right now, out of stock on silver bars. Even the basic 1 kilogram bars, the kind that are normally as boring and available as bricks, are gone. When an institution like that runs dry, you're not looking at a coincidence. You're looking at stress in the system. Now zoom out for a moment. Australia's Perth Mint, the US Mint, the Royal Mint in the UK. Different continents, different supply chains, different currencies. Same problem at the same time. That's not bad luck. That's not timing. That's a systemic issue showing up everywhere at once. And just when you think you've heard it all, enter Costco. Yes, that Costco. The place famous for selling absurd quantities of everyday items to anyone willing to push a very large cart. They sell silver bullion. And they've now imposed purchase limits. Let that land properly. A retailer built on volume sales is rationing silver. You can buy a year's worth of toilet paper, but not unlimited bullion. Why? Because demand is overwhelming supply, and they're protecting inventory from vanishing in hours. That alone should make you uncomfortable. But the most unsettling data isn't coming from the West at all. It's coming from China. Let's talk numbers. As of today, January 30th, the Shanghai Futures Exchange silver vaults hold approximately 455 metric tons of silver. That sounds impressive until you translate it. That's about 14.6 million ounces. In the context of global demand, that's nothing. Annual silver demand worldwide exceeds 1 billion ounces. These vaults hold barely over 1% of that, a rounding error. Now here's the part that should make you sit up straight. In a single day, nearly 27 metric tons of silver were withdrawn from those vaults. One day. That's roughly 870,000 ounces gone in 24 hours. At that pace, those vaults could be functionally empty in a matter of weeks. Not years. Weeks. And almost nobody in mainstream financial media is talking about it. Now, you'll get endless panels debating rate cuts and equity multiples, but silence on one of the fastest physical silver drawdowns in recent history. That silence isn't accidental, it's convenient. What makes this even more serious is China's policy stance. Silver has been classified as a strategic asset. Exports have been restricted. The metal is being treated the same way China treats rare earths and critical materials tied to defense, technology, and infrastructure. So think about the behavior here. China is limiting what leaves the country while simultaneously draining its own exchange vaults. Public silver is being moved into private hands and strategic reserves. That's not speculation, that's preparation. While Western markets are focused on price charts and paper contracts, China is securing physical supply. They're not betting on silver, they're planning with it. And that difference matters. Now ask yourself a simple question. Who do you think has a clearer view of silver's real value? The side aggressively selling paper contracts they don't have, or the side quietly taking delivery of every ounce they can get? That brings us to who's actually driving the sell-off. Because this part is critical, and it's not being talked about enough. Nearly all of the aggressive selling this week has happened during US trading hours, not during Asian sessions, not during European hours. When New York opens, silver drops, heavy volume, sharp red candles. When New York closes, the selling stops. Sometimes price even stabilizes or ticks higher during Asian trading. Then New York opens again and the cycle repeats. That's not random, that's behavior. What's happening is simple, even if the implications are uncomfortable. US banks and institutions are flooding the paper market with sell orders, futures, derivatives, digital silver created with keystrokes. They're manufacturing supply on a screen. Meanwhile, buyers in Asia and the Middle East are doing the exact opposite. They're not trading contracts, they're taking delivery. Bars are being loaded onto trucks, vaults are being emptied. Real metal is leaving the system. One side is playing a financial game, the other side is walking away with the asset. This isn't new. For decades, the pattern has been the same. The West sells paper, the East buys physical. But what's different now is the scale and the urgency. The disconnect has widened to an extreme we haven't seen before. Paper prices are collapsing while physical availability is evaporating. That's not a free market. That's a distorted one. And here's where people get hurt. When you don't understand the mechanics, you react emotionally. You see the price drop on a screen and you panic. You sell physical metal at the worst possible moment because a digital number scared you. And someone in Shanghai, Dubai, or Mumbai gladly takes it off your hands knowing exactly what it's worth. If you want another confirmation that something is broken, look at lease rates. Lease rates tell you what it costs to borrow physical silver. In calm, functional markets, those rates sit close to zero. 0.5%, maybe less. Right now, they've exploded. Reports range from 8% to as high as 39%. 39% to borrow silver. That's not normal. That's not even unhealthy. That's emergency level stress. It means holders of physical silver are demanding massive compensation just to let go of it temporarily. That only happens when supply is critically tight. So connect the dots. Mints are suspending sales. Dealers are defaulting. Vaults are draining. Lease rates are screaming. Exports are being restricted. And yet, the paper price says silver is cheap. One of these signals is wrong. For decades, the paper market has dominated silver pricing. Enormous volumes of contracts trade daily, dwarfing the physical market. That's allowed prices to be controlled and suppressed. But systems like that only work as long as physical demand stays quiet. That condition no longer exists. What we're witnessing now is the pricing mechanism itself coming under pressure. Physical demand is overwhelming a paper-based system that was never designed to deliver metal at scale. Eventually, something has to give. Either prices rise sharply to reflect reality, or the physical market breaks down further. There is no stable middle ground here. So what does this mean for you? Because understanding the problem without understanding the response is useless. If you hold physical silver, this is not the moment to panic. Don't let a screen price bully you into selling the very thing the rest of the world is scrambling to acquire. Look at actions, not headlines. Governments are rationing, mints are pausing, China is hoarding, lease rates are flashing red. You're holding an asset that's becoming harder to replace by the day. The paper price is noise. It's leverage unwinding and forced selling. Physical silver is worth what someone is willing to pay for it in the real world. And right now, the real world is telling you it's scarce. At this point, let's be very clear about something. Whatever number you see flashing on a screen right now, the real value of physical silver is already far above it, way above $95, and that gap is telling you more than any chart ever could. If you are holding real metal, bars, or coins you can actually touch, this is not the moment to flinch. This is not the moment to let a red candle scare you into handing over an asset the rest of the world is scrambling to secure. Hold your metal. Don't let noise shake you out. If, on the other hand, your exposure to silver exists mostly on paper, ETFs, futures contracts, digital products, I want you to ask yourself one uncomfortable question. If tomorrow morning everyone holding those contracts asked for physical delivery, could the system actually deliver the silver? Honestly, not theoretically, not eventually. Physically deliver. The answer, in almost every case, is no. There simply isn't enough metal. What you own isn't silver. It's a promise. And promises work fine until stress shows up. When stress arrives, promises tend to snap. Now, let's talk about buyers, because this is where things get interesting. If you're trying to buy physical silver right now, good luck. Premiums are exploding across the globe. In Japan, buyers are paying as much as 60% over the quoted paper price. In Dubai, closer to 40%. In other words, the screen might say $95, but the real-world transaction price is more like $120, $130, sometimes even higher, depending on availability. If you manage to find physical silver at what feels like a reasonable premium, consider yourself lucky. That inventory is not sitting around waiting for you. It's moving fast. Here's the paradox that most people struggle to wrap their heads around. The lower the paper price goes, the faster physical silver disappears. Normally, lower prices reduce demand. Here, lower prices are pouring gasoline on the fire. Every drop triggers more buying. More buying drains supply faster. The crash isn't solving the shortage, it's intensifying it. Some people will hear all this and immediately dismiss it as exaggeration or conspiracy. They'll say the silver market is functioning normally. They'll say mints are just having temporary issues, logistics problems, nothing more. To those people, I'd say forget opinions and look at evidence. The Perth Mint paused sales. The US Mint suspended products and repriced nearly 86% higher. The Royal Mint in the UK ran out of silver bars. Indian dealers are defaulting on deliveries. Costco has imposed purchase limits. Shanghai vaults lost 27 tons in a single day. Lease rates spiked as high as 39%. That's not a glitch. That's not coincidence. That's global stress showing up everywhere at once. This also isn't happening at a random time. Today is Friday, the final trading day of January and the last day of the week. Big moves love Fridays, especially end-of-month Fridays. Options expire, futures settle, positions get closed or rolled, books get cleaned up. January was one of the strongest months for silver in decades, up roughly 65% at the highs. Record moves. And then, on the very last day, the market gets smashed. That's not accidental. That's how weak hands are shaken out. Fear is manufactured, confidence is tested, and assets quietly move from impatient sellers to patient accumulators. This is how the game works. Your panic becomes someone else's opportunity. To really understand why this moment matters, you have to zoom out. What you're seeing didn't start this week. It didn't even start this year. This has been building for a long time. Silver has been in a structural deficit for 5 consecutive years. 5. Since 2021, global demand has exceeded global supply every single year. On average, the world mines about 835 million ounces of silver annually. That's total production. But annual demand regularly exceeds 1 billion ounces. Industrial demand alone keeps climbing. Solar panels, electronics, electric vehicles, medical equipment, defense applications. Add investment demand for coins, bars, ETFs, plus jewelry and silverware, and the math simply doesn't work. Demand beats supply by hundreds of millions of ounces every year. So where does that extra silver come from? It comes from above-ground stockpiles, vaults, inventories built up over decades when supply exceeded demand. Think of it like a bathtub. Mine supply is the faucet. Demand is the drain. For 5 years, more water has been draining out than flowing in. The tub doesn't empty overnight, but eventually you hear the slurp. That's where we are now. The cumulative deficit over those 5 years is over 800 million ounces. 800 million. That buffer has been quietly shrinking, and now it's almost gone. Shanghai vault levels are critically low. COMEX registered silver has been trending down for years. London vaults have seen significant drawdowns as metal flows east to India and Asia. There is no excess inventory waiting to save the day. No hidden mountain of silver ready to flood the market when demand spikes. And now, with mint suspending sales and dealers defaulting, we're seeing the consequences of those deficits collide with reality. This isn't a problem that clears up next week or next month. This is a structural issue years in the making, and it's accelerating. So what happens next? In my view, we're entering a new phase of this bull market, a phase where the paper and physical markets drift further apart instead of snapping back together. Paper prices will remain volatile. They may crash, they may spike, they will continue to be influenced by leverage, margin calls, and policy decisions, as long as the paper market dominates price discovery. But physical silver will keep getting harder to find. Premiums will rise. Availability will shrink. Eventually, the idea of buying physical silver anywhere near the paper price will feel absurd. In many regions, it already does. Japan paying 60% over spot. Dubai paying 40%. That gap isn't closing, it's widening. The disconnect is growing, not shrinking. We've seen this movie before. In 1979 and 1980, during the last major silver squeeze, similar dynamics played out. Dealers ran out of inventory. Premiums exploded. Paper and physical prices diverged. People couldn't find silver to buy even as prices were moving wildly. Eventually, the paper market had no choice but to catch up to physical reality. Silver went from around $6 to nearly $50 in a matter of months, an 800% move. One of the greatest commodity rallies in history. I'm not saying history will repeat exactly. The market structure is different now. The players are different. There are circuit breakers, position limits, and regulatory tools that didn't exist back then. But the core dynamic hasn't changed. When physical supply cannot meet physical demand, price must eventually adjust upward. Paper manipulation can delay that adjustment. It cannot stop it forever. You can create paper silver with keystrokes. You cannot create physical silver out of thin air. At some point, reality wins. It always does. The only real question is timing. And based on mints shutting down, vaults draining, and lease rates screaming, that moment feels uncomfortably close. Right now, there are three kinds of people watching this unfold. The first is scared. They see the crash, feel the fear, and want out. They react emotionally. The second is confused. They see conflicting signals, prices falling, but shortages everywhere, and they freeze. They don't know what to do. The third understands. They recognize the paper crash for what it is. They recognize the physical shortage for what it is. They see opportunity where others see chaos. Which one are you? Let me leave you with this. The paper price of silver dropped more than 20% this week. And that same week, the Perth Mint paused sales. The US Mint suspended sales. The Royal Mint ran out of stock. Indian dealers defaulted. China drained 27 tons in a single day. Lease rates surged to levels that scream panic. Price went down. Physical metal disappeared. One of those signals is lying. And it's not the empty vaults. This is what manipulation looks like. This is what a broken pricing mechanism looks like. This is what happens when a system built on promises collides with physical reality. They dumped silver. The world ran out. And you get to choose which side of that equation you want to stand on. I'll continue tracking this as it develops. Make sure you're subscribed and notifications are on so you don't miss what comes next. Drop a comment and tell me which you think wins this battle, paper or physical. I read every single one. And remember what we started with. The price is crashing, but you can't buy the product. That's not a market. That's a magic trick. And now you know exactly how it works.